Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the ForexPeaceArmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit ForexPeaceArmy.com forum and read my analysis for the week before watching this daily video.
Welcome back, guys. Let's have a look on the gold market. So today report has appeared to be a bit more extended than usual, but just to calm you a bit, the material in the report was relatively light, so it is no sophisticated conclusions, charts and so on. So some common things to read, but the material that we have provided lets you to create the overall view on what's going on in the gold market, what's the major drivers of the growth, and actually make the conclusion on the further perspective. So this report we have provided some confirmation, some improvement that our suggestion that the party is still in the beginning, is yet to start. It corresponds to reality. So we suggest that the gold is still in the beginning of the possible big upward action. Also, we have made some historical comparison with the crisis of 2008, and there are lots of similar swings, similar price behavior. This time, of course, it might be a bit different, but the fundamental factors that actually driving the gold market on the long-term charts, and the monthly is a long-term chart, I think it stands in place. And towards speaking, we already actually talked about this previous report, but just to remind you that usually the bullish cycle splits in two parts: in preparation for the big rally, the major part of the bullish swing on the gold market, and the final part. And between these parts, usually the deep retracement, moderately deep, so it's somewhere around 30% might be. The reason for that is a collapse usually on the stock market that happens in the middle of the gold rally. And when collapse happens, investors start running and demanding big liquidity to plug the holes in the balance sheets, in the margin calls. And that leads to sell-off on other assets. This is not because of the revaluation of the gold or something. It's just purely technical liquidity factor. It has happened many times already. It happens every time. It has happened in 2008, and with the high degree of the probability, it will happen once again. Where it will happen, difficult to say, but approximately around 3-4 months until this moment. Somewhere in the winter of 2025, this could happen, or close to the end of the winter, it could happen. So you will read about this in a report. Also, you will see the signs why this probably will happen rather soon, because the stock market is coming in the final stage of the total madness. And just we provide some facts for that. And also lots of stuff interesting in the report. So as I said, material is very light, so without any sophisticated analysis of the different sulfur rate that we have discussed last time, and some digging on some liquidity issues and so on. So it's just pleasure to read, but a lot of interesting stuff there. Hopefully you will not be overloaded with information, and I've tried to put only most necessary stuff. Speaking about technical side, there are two, I would say, parts in our trading plan now. First is we consider next target as a 2760, because this is a target on the weekly chart. So you also will see in the report the chart on the weekly and understand why we're speaking about. But first, we will be dealing with the daily target. And the first part of our training plan is market reaction, or at least possible reaction, on the target 1618 extension of this most recent retracement. If this reaction will happen, so most probable retracement starts when the market will complete this target. This is actually, I would call it as an area 2737, 2742. Why the 42 you will see a bit later, so on the intraday charts. So once market will hit it, if we will get the pullback, these levels, guys, are built on the suggestion that market will reach this target. So they are currently slightly higher than the real levels based on this top. So I put the final points of the reaction right here. So this level is based on this top and is around the target 27.37, and we will get the pullback to the 26.85, 30% retracement and retesting of these lows. This will be a great game to us. Also, I wouldn't consider any other levels outside of this most recent swing, just because of the validity of the bullish trend. So currently the trend stands bullish until the 26.50 area. If market starts retracement, this break-even point will rise even higher. And from that standpoint, we're not interested in any other levels that stand below or some larger scale swings, because if market will break below this area, trend will turn bearish, and it will be no sense in a bullish scenario anymore, because we will change the game. So all this stuff is valid only until price stands above this area. That's why we're not considering any other levels outside of this most recent swing. This is a relatively short-term setup. So on the 4-hour time frame chart, I see mostly nothing interesting. We probably could return back to idea of actually not even the idea, but just keep following with our hand shoulders pattern that we have. So next target based on this hand shoulders pattern, the XOP. That explains why I'm also watching for 27.42 area. This is actually XOP. It stands in agreement with the daily target 27.37, so it's just $5 difference, and I would treat it as a single target. Concerning dealing with this target and how to trade it, probably you maybe have your own solution, but by my opinion, taking a position right here, it's not very attractive, because the distance to the target and distance to the nearest support area are similar. And from that standpoint of view, there is no positive probability on your side. So you have one-on-one ratio of the possible result. By my opinion, is that I would prefer to wait for some retracement. For instance, if market will show at least minor pullback, say to the 27 or 26.90, the first level, that will be at least something, because in this case, you will be able to place relatively tight stop somewhere below confidence or just below this trend line. It will be enough. And probability will be on your side, because your risk reward will be 2-to-1. This will be a potentially positive trade based on math expectation. So that's just my 2 cents. Maybe you will find some other reasons how to make the probability stay on your side. Maybe you will trade even on lower time frames. There may be some different steps on 5-minute charts, for example. So, but this is just my opinion on concerning the hourly chart. So that and towards our trading plan for next week. Just as a bottom line, we're starting from the intraday charts and watching for this scenario. Hopefully we get some pullback. If we will get nothing, then we turn to the daily chart, the second part of our scenario, and watching for the pullback out from the 27.40 area approximately, and watching for possible another long entry on some predefined fib levels. If conversely we will get the retracement in the beginning of the week prior the market will reach this target, all the better. We will consider additional long entry with a way to nearest intraday target.